The banking industry is still in a state of turmoil, even after a hastily arranged buyout of Credit Suisse Bank, which was aimed at shoring up the financial sector after the collapse of the U.S.-based Silicon Valley and Signature banks in less than a week. The Federal Reserve has been in damage control in the days since, and in the months before the collapse. The institution had been steadily raising interest rates in an effort to keep inflation under control, an effort that by all accounts was a major contributor to the bank's demise. So, how did we get here? A new documentary from Frontline traces a line from our precarious economic moment all the way back to the decisions that the Fed made in response to the 2008 economic crisis.
But amid the crisis, Fed officials decided to do something they hadn't done in half a century. They began dropping rates, eventually to almost zero.
It's almost like alchemy. You can create money out of thin air if you're at the central bank. So creating more money puts more money in the banking system, put more money out there for the economy to take it and put it to work, and to grow, and to restore itself.
Their hope was that the new money would help shore up the failing banks and get them lending again. It would become the heart of their easy money policies.
And the film is called The Age of Easy Money. Director James Jacoby, who we just heard in that clip, joins me now. James, thanks for being with me.
It's good to be here. Thank you.
So this film, 2 hours worth of an examination of what you call the age of easy money. What is easy money? What makes money easy?
What makes money easy? Well, the Federal Reserve controls interest rates, as you said just a second ago. And basically, when interest rates are really low, it means money is easy. It's cheaper. It's easier to borrow. More people can borrow cheaply. And it's meant to kind of stimulate economic activity. More people borrowing, more people spending, more companies borrowing and spending. And so for the past 14 years or so, since the great financial crisis, we've had the Fed doing very easy money policies, meaning interest rates have been incredibly low for the past 14 years, up until very recently. And they've been using all sorts of other extraordinary measures to try to keep rates low and money flowing in the system.
Yeah, so this documentary, 2 years of work making this. What was your thesis going in? Did you have a handle on this and know this is exactly the story you were going to be telling 2 years ago? Or has it developed over the course of that time?
It's developed over the course of that time. I mean, we had done a film at Frontline called Power of the Fed, and we've taken some bits and pieces from that old film, and that film really was done after COVID, after the Fed had come in to an enormous degree with trillions of dollars to kind of rescue the markets, the financial markets, and the financial system during COVID. And it caught our eye just because it was something that was so extraordinary, that was so undercovered. Right. And I mean, so many things were needed coverage during the pandemic, but that was one of the things that we were like, oh, well, that must mean something. There must be some reason why they needed to spend trillions of dollars to shore up the financial system. So we did a film. It was an hour film that aired in July of 2021. And it was sort of our initial look at things. But then what has happened since has been extraordinary, because that film looked at, the easy money experiment. And we were still in kind of a boom time then. But then, of course, we've had inflation. The Fed has had to raise rates. And so we really now have a full narrative arc of this 14 years and this extraordinary economic experiment they've been running.
Yeah, and 14 years is obviously a fair amount of time. And over the 2 hours of this film, we really see how many areas of our lives this, as you call it, easy money policy has impacted. A lot of takeaways. I just want to maybe draw on some of the themes that stuck out to me in the film. One is there's this, running through the whole thing, it feels like there's what I think of as like a cat and mouse game happening a little bit between the Fed and the stock market. There's all of these policies that happen. The Fed does something, maybe because they think that the stock market is going to do this thing in response. Then something else happens, and it comes back to the Fed, and then they have to adjust. What's going on with this cat and mouse game with the Fed and the stock market?
That's a very good way of putting it, as a cat and mouse game. I mean, basically what happens is all this kind of easy money, this flood of money into the system and low rates, really has stimulated the stock market. The stock market and the bond market and all markets love it. Asset prices have been going up and up and up for the past 14 years, up until recently. And what happened was these were initially extraordinary measures that were taken, almost emergency measures that were taken in the wake of the 2008 crisis to shore up the banking system and to sort of stop a stock market crash in the making at that point in time and avert a catastrophe. Well, of course, you do this emergency measure once, it works really well, the markets become addicted. And the kind of the cat and mouse game is that the Fed has actually over the years tried to pull back on these policies, raise rates a little bit, pull away all these extraordinary measures. And the markets throw what's called a tantrum. It's called a taper tantrum. They've done it a few times over the course of these 14 years. We document a couple of those times in this film. And it really speaks to this kind of addiction that our financial markets have and just our broader economy to these very easy money policies.
Of course, over the last 14 plus years, we've seen an increase in income inequality. That's something that you address in the film. At one point, you visit a food bank in Phoenix. And interestingly, at this point, you talk about the easy money policy, and now you're saying they started to raise interest rates because there's this inflation problem that has happened now. And it's the inflation problem, it seems like, in Phoenix that's really causing much more of an issue than even COVID did in terms of the numbers they're seeing, people who are income challenged who are using this food bank in Phoenix. And yet, at the same time, through the course of this film, you say easy money. I hear these economists saying things like, there's just too much money out there. There's so much money sloshing around. And so there's this disconnect between this idea that there's all of this money, and yet we have this income inequality. What the heck is going on?
Well, one of the main unintended consequences here is a lot of these policies were well-intended. They were intended to really try to stimulate economic growth, try to grow to get wages up for middle and lower income level Americans. And what we've seen instead, however, is that we have this widening gap between the financial economy and the real economy. And that disparity is something that we were very keen to kind of point out over and over, because in these years where Wall Street has gone gangbusters thanks to these policies, and we've seen asset prices, stock market, the housing market, anyone who owns assets has seen their wealth soar as a result of these policies. The people without assets have been falling behind, and wages haven't been rising. Only very recently have wages been really rising for basically lower and middle income people in this country, but they're not even keeping pace with inflation right now. So it's and the irony is that now that the Fed is pulling back on easy money to try to get inflation under control, well, of course, the people hurt most by that are going to be the most vulnerable in our society. It's going to be people whose jobs are more precarious and livelihoods are more precarious, who are going to be affected by higher rates. So it's a real bind.
Yeah, of course, you can't divorce the economy from politics. You don't in this film, and the political ramifications are wide-ranging. It's almost easy to forget today. One of the things that this film addresses is the fact that we've been in this period of political divisiveness for some time. We're used to it. Right now, it's sort of centered a lot around these culture wars. But you talk about how the roots of the Tea Party movement, for example, were very, very much financially driven. It had to do with how the government responded in 2008 to the financial crisis, and that was a real driver of the Tea Party at the beginning. At the same time, you also point out the fact that political intractability has somewhat altered the way the Fed is behaving, and they're starting to do things that maybe were outside of their mandate if we think about what they were supposed to be doing, say, 20 years ago.
Yeah, no, that's perfectly put. I mean, we really do make a lot of the Tea Party moment in 2010. Obviously, there were a lot of things propelling the Tea Party movement. We really focused on the economic drivers, and there was a genuine anger in this country, not just with the Tea Party, but also, if we remember, Occupy Wall Street, so on the right and the left, about the bank bailouts, about the fact that there was this completely unfair response to the 2008 crisis where, ordinary Americans lose their homes, yet bankers are not held accountable for bringing the economy to the brink. So the Tea Party movement, however, was a movement of no. And they really didn't like the $800 billion stimulus that Obama had passed in the wake of the crisis. They saw big government and big bailouts as a big problem. And so they come propelled into power with the Republicans in 2010, really thwart the Obama agenda And we've always, there's been a couple of decades of increasing political dysfunction and partisan politics in this country. But really at that point in time, it went into kind of overdrive. And the Fed, filled the void when it came to economic policy, because basically no major economic policy could get done in Washington after that point.
10 years after this sort of dawn of the age of easy money, we're 10 years into an era of easy money, and the COVID crisis hits. And we have this, yet again, huge infusion of money into our economic system. Have a cut from the film here with a couple of economists addressing what happened as COVID hit.
People like myself, like Larry Summers and others, saw that massive stimulus that was unprecedented, an order of magnitude greater than the one we had after the global financial crisis, will lead to excessive demand, overheating, and inflation.
Well, we saw a number of factors that we thought were conspiring to lead to high prices, and that many of those factors would fade away over time. So, for example, supply chains we saw were getting gummed up.
Any regret about not taking the foot off the pedal, seeing what, for instance, the federal government was doing at that point in time?
Well, I think, again, knowing what I know now, absolutely.
Interesting stuff. I mean, like, how do you get your head around this?
Yeah, well, what happened was there was an extraordinary response by both the Fed and the federal government to the pandemic. And the Trump administration did the CARES Act. That was the largest economic stimulus bill in U.S. history. And $2.2 trillion of aid for Americans that were, obviously our economy was put into a coma and they had to do something. Meantime, the Fed was doing trillions of dollars of stimulus into the banking system, quantitative easing, this tool that they use to try to keep rates down and keep money flowing. So there was all this money going out there. And then Biden comes in, does more stimulus. And we all remember it, but there were supply chain problems. There were, all sorts of things and weird things in the economy as a result of the pandemic. And so you had all of this money flowing into the system, creating economic demand, which is good. However, you have all sorts of supply problems, and the sort of economics 101 is too much money chasing too few goods or services. You get price hikes, you get inflation. And we got inflation. And so those exchanges, Nouriel Roubini was one of the economists out there with Larry Summers from Harvard, basically saying, look, we've got to pay attention to this because inflation may be a problem. It hasn't been a problem since the 70s or early 80s, but maybe a problem again. And the Fed was caught a bit flat-footed about it. They thought at first it would be what they called transitory. They thought that it was just sort of a temporary blip. But it very quickly proved not to be, and they were late in the game in taking their foot off the pedal.
And of course, that leads us to today. Inflation obviously happening for those of us on the ground, but a major contributor to another banking crisis that we're dealing with. Your film ends, I don't want to say, it's not a cliffhanger, but it's a somewhat ominous note. Like, the film is definitely more Empire Strikes Back than it is the original Star Wars, right? There's this feeling, this looming something could happen because we have to change, or we're in the beginnings of changing the way we do things. And is it fair to say that, you were fairly prescient a little bit to, because here we are last week with serious banking things happening?
Yeah, it was a little bit wild, I have to say. I mean, we did, there's a sort of physics to this, right? I mean, the fact of the matter is, interest rates, we don't often think about it, and it's not something I think about in my daily life. Bankers think about it and whatnot. They're the gravity in the financial and economic system. It's the most important thing. It's the price of borrowing. It's the price of money. And if interest rates have been kept at a very low rate for 14 years, and an economic system kind of calibrates to that in a financial system, of course there's going to be a massive effect when you pull back on that and you hike rates. And so we didn't know the timing of it, but we knew that there would be ripple effects and lag effects from that. And it just happened that, 3-4 days before the film was set to air, we had a locked cut. We had to reopen it because guess what? I mean, a bank collapses because it hadn't managed its interest rate risks. And so Then the Fed steps in, even though they said the bar would be very high for stepping in such a crisis, and they stepped in. And so, we were on the news with something that we'd worked 2 years on. We didn't know the timing, of course, but it was a matter of time. And as you said about the sort of cliffhanger aspect of this, I unfortunately, we are sort of in the early innings of this. When the Fed raises rates, these are very blunt instruments. It takes time to cycle through the system. I think that there's more disruption to come. I don't think we're necessarily in a crisis, but I think that we have to really watch this very carefully. And the Fed and certainly the Treasury Department, the administration, they're all doing that.
The documentary from Frontline is The Age of Easy Money. James Jacoby, thanks for being with us.
Thank you so much.
And you can find the film online now at pbs.org/frontline.